absolutely smashes it. He's always getting turning good profits with his trades and being smart about it. So I invited Donny into the crypto den to just have a chat with everyone, start sharing some ideas and some information, and just to try and teach some of the community more about how trading works and how to become a trader in the future as well. So as we spoke about last week, it's not a quick process. It does take time to learn. It does take even more time to learn how to execute it. So with that being said, welcome back, Donny. I'll hand it over to you and we'll get everything started.
Appreciate it, bro. Thanks for having me. Guys, can I just get a quick show of hands? Like, how many of you guys were here last week, and how many of you guys is your first night on with us?
First time here.
First time here? Okay. Yep. I'll just do a real quick introduction then. Dave pretty much just said it then. I've been around trading for a long period of my life. Not so much actively trading, just, in the, finance sector, whether it be investing. I've always been a businessman. I've run businesses since I was like 16 years old. I was always that kid who was at school selling cigarettes or alcohol or something like that. I always had a bit of a side hustle. That was me. I was that kid. So I've always been in and around anything entrepreneurial. Started my own mechanical business when I was about 21, I think it was, building race cars and stuff for a living all around Australia. But yeah, I got stuck into trading seriously about 3 years ago. A mate of mine sort of put me onto crypto, and I sort of got stuck right into it. Realized the potential to make really good money and get out of my 9 to 5, because owning a business isn't all it's cracked up to be. It's it sounds glorious. Sounds like you're going to have all this time on your hand and make all this money, but eventually you just end up working ridiculous hours, and the money's not all it's cracked up to be. By the time I had 3 factories and staff and stuff like that. I'd have to turn 20K a month just to pay bills, sort of thing. So it was pretty tricky going. So trading for me was a way out. It was a way that I could earn money on my own time with no sort of limitations. It's not about having to do more work. Sometimes it's just about getting good and compounding your account and having more money to play with, or having really good strategies and things like that. But it meant I could spend a lot more time with my family, because I've got 5 kids and I didn't really get to spend a whole lot of time with them in my business. So this was a really big life-changing moment for me, that I had to get good at this. And look, it did take a while. I would say, roughly 2 to 3 years before I'd consider myself a professional trader or a successful trader, someone who can actually make a living off trading on a regular basis. So yeah, it was about 3 or 4 months ago when I finally kicked the business to the curb, sold everything I had, and handed the keys back to the factories, and now this is what I do, and couldn't be happier. But it is a long, hard road. A lot of people come into trading, especially with crypto, because it's so volatile. They make money really quickly and think this is easy. The thing is, when people come into a bull market and you're just throwing darts at the board and everything's going up and you think you're a genius, it's when the market flips and starts going the other way that you don't know what to do, because that strategy you were using wasn't working. It doesn't work anymore. And you start to lose everything you had gained. And that kind of what happened to me. And I realized that there's potential to make money, but I just need to know what I'm doing. So I got stuck into it. Now, what I want to ask you guys is sort of what level of, education have you guys got around trading? Like, are some of you guys new to trading? You've been in it for a bit, or never really taken the plunge to learn technical analysis or anything like that? Just put it in the chat, just so I've got an idea of where to start with you guys. Simon, none at all. Okay. All right. You never seen a candlestick chart at all, Simon? Paul? Paul?
A little, but not major. Just okay. I've been some research in the last few weeks, yeah.
Yeah. Paul Byrne. Sounds familiar. Paul, I know you, don't I, Paul?
G'day, Donny. You certainly do,
I-
mate.
I
From,
do.
UTG. How's it going, big fella?
Good, bro. The names sound familiar. I'm like, I know Paul.
Yes, mate.
Awesome.
You're the one that got me out of a few liquidations, mate.
Yes, I do remember that. So, Paul, for you guys, Paul is someone I mentored about almost 2 years ago, or maybe not 2 years ago, about 2 years ago, something like
Yeah,
that.
close to two, mate. Yeah.
Yeah. And Paul, just typical newcomer to trading. You develop bad habits, and you're still trying to sort of find your way. But yeah, how's things going now, Paul? Have you sort of
Yeah,
gotten the
mate.
hang of it?
Yeah, good. Thanks. I use the trade and risk thing that you guys set up years ago that you did a while back,
Yeah.
Donny.
Position size calculator and risk
that-
management and stuff like
That's
that.
it, mate. And I did a fair bit of scalping there for a while to build the bank account up, and now I'm going a bit back, more to the swing trading side of it, longer time frames and stuff like that. So, yeah.
That's awesome, man.
I try not to get myself into trouble. Every now and then I try and double in and get into a bit, but I certainly use the stop losses and don't move them. That was the biggest thing that, as you probably remember, I used to try and add to my position and get in deeper and deeper and move that stop loss down.
Buying
All of
into a
sudden,
bag.
that's right. And all of a sudden,
that-
you're $500 or $600 down, and you think, yeah, I'll hang on, and the market doesn't stop, mate. As you know, it just keeps going and breaks you.
Yeah, that's a bad habit that a lot of people have, is possibly getting a little bit too emotionally attached to the trade. Like jumping in looks really good, but it's pulled back a lot further than you thought. So you're like, oh, it still looks too good. I'll go in a bit deeper and try and dollar cost average and fix your entry. And before you know it, you end up 5-6R, which is 5 or 6 times as much as you were willing to originally put on the trade. And when you finally cut your losses, it's a big hit. And it really messes with the psychology, because then all of a sudden you go into revenge mode and you're like, I have to make that back. That was a stupid mistake. I know I stuffed up. Why did I break my rules? Now I've got to try and make that back. And it just sends you into a pretty downward spiral. Sometimes people go belly up that way. Look, everyone goes through that stage. It's part of trading. Like, I haven't really heard many success stories with people trading who's come in, learnt, and just become these phenomenal traders without having a few liquidations or copping a few big losses and blowing up in a can or two. It does happen. But yeah,
I think
that's
the general consensus from TCD is majority are probably bag holders. I'd say majority are people that got in, end of 2017, start of 2018, and they've just been holding bags for years. I'd say a very few percentage are traders or know how to trade, or at least chart. Because there's a difference between knowing how to chart and knowing how to trade. You need to learn how to execute your charts and whatnot. But I think that's probably what we're aiming at here. We're probably better off starting, pretty basic. I mean, there's a lot of different strategies that require different commitments and whatnot. So, I mean, how would you juggle it all?
Yeah, definitely. So this was something I came to the realization quite early on, was, when you first get stuck into it and you start learning TA, you start seeing all these things that are working, and you want to try everything. So you're trying all the indicators, you're trying all these different strategies, and you're trying the smaller time frames, the higher time frames. You try everything, trying to find that magic sort of pill that works for you. And I think a lot of people go through this stage where they get like addicted to trading, especially when you're having some good wins and stuff like that. It takes over your life. It took over my life and potentially destroyed my business at one stage, because all I did was sit in front of the computer trying to chart, because I was just so addicted to it. But I quickly realized that was not a very healthy way to do it. And to be honest, I wasn't even that successful at doing it. I look back on the time that I wasted, that I should have been in the workshop spinning spanners, and instead I was in front of the computer, and I may have had those few wins, those few losses, and thinking that I'm killing it. But then you look back at the end of the month and you're like, oh shit, I made like $1,000. I need to pay like $20,000 in bills. Like, what a waste of fucking time. So I quickly realized that wasn't a strategy that works for me, because I don't have the time to sit there and trade that active. Everyone's different. Some people, don't have a job, or they've got the ability to work from home or even work on a computer. So they might have multiple screens set up and be able to trade actively while you're working or whatever on the side, which is quite handy. But one thing I quickly learned was the smaller timeframes requires a whole lot more level of commitment. And most people can't commit to that for various reasons. You've got a job or you've got a family and you just don't have the time. Not everyone has the time to sit there and scalp and day trade. Scalping is like the most addictive thing that most people want to learn because it's quick, fast money. Everyone wants quick, fast money. That's what it is. That's the enticing thing to trading and crypto. It's quick, fast money, which is what everyone comes here for. And scalping is that ultimate, that drug of quick, fast money. But the problem is that it's very few and far between do you get an actual good scalping session. So people just assume that like, hey, I've got an hour to kill. I'm going to jump on the computer and do some scalping. The problem is if the market's not set up right, it's really hard to scalp. Scalping smaller time frames, on the 1 and the 5 minute time frames really only works when the market's in a certain situation. And if it's not like that, you're not going to find your entries. You're not going to get your exits. It's not going to be volatile enough to get in and out on high leverage. So it just doesn't work. Scalping isn't something you can choose to do at a specific time. It's more a case of when the market's ready for it, it might be a good time to scalp. But if that good time to scalp is 3 o'clock in the afternoon on a Tuesday when you're still at work, well, you're going to miss that session. So that's a bit of a waste of time. So scalping, it's not really for everyone. And then to branch up from that, you've got day trading is another type of what you'd sort of call a type of trader. A day trader is typically in traditional markets. It's someone who trades the working day or open hours of a market. So in traditional markets, we're open 10 till 5 on, ASX and stuff like that. So you'd be waking up in the morning, you'd be doing your charts, you find an entry, you jump in. Within the end of the day, you're closing your trade. That's essentially a day. You're not really holding trades for much longer than a day. Sometimes 2 hours, 3 hours, 4 hours. If by the end of the day, your position hasn't really done anything, you might still close out and re-enter the next day because you don't want to get stuck in the market on the next day. Sometimes you get gaps when the market opens the following day. And that's the downside of a market that's not open 24/7 like crypto is. So that's typically a day trader. Again, that kind of suits someone who has the time to sit there and actively trade, which like most of you guys, if you've got day jobs, that's not going to work for you very well. Then you've got swing trading. Now, this is kind of a category that most people are a little bit turned off with because it seems too slow, but it actually fits into most people's lifestyle the best. And to be honest, most people who start to learn to trade, they go through all those motions of learning all the different strategies. They normally end up swing trading, unless you become a professional trader and you're able to, trade. And you're able to trade full time and start doing scalping and day trading on those smaller time frames because you are in front of the computer. But when you've got a day job, swing trading is probably the strategy you really want to be using. Now, swing trading is something you do more so on the higher time frames. You'd be looking at like the 4 hour and the 1 hour chart. The 4 hour on the daily chart, and you're sort of just trading with the trends. You're looking for entries on the smaller time frames, but you might hold a position for anywhere from 2 days, 3 days, a week. I've held trades for 2 or 3 months if the market's going the way I want it. But typically you're talking like a week or two for most trades to play out. So this doesn't really require a whole lot of effort. I can do a successful trade that might take 2 weeks, but it only really requires maybe 2 or 3 hours of actual what you'd consider work in front of the computer for that trade to play out. Half an hour in the morning, you set up the trade, you have a look, you go on TradingView, you find a trade, cool, you set up your order and you go to work and you don't really have to do anything again. Once your trade's filled, you might just set some alerts to sort of monitor it so that you can, be alerted on your phone to say, hey, it's doing something. You might want to go check it. But if your alerts aren't going off, there's no need to check it because it's doing what you want it to do. It's only when it starts to go the other way, you want your alerts to say, hey, this trade's not playing out. Maybe it's time to get out. But if you automate your trade with take profits and stuff, you don't even have to actively go and manage your trade anyway. So that type of trading suits a lot of people because you can set your trade up in the morning, you can go to work and you can ignore the thing for the next 2 or 3 days until your alert hits and says, hey, you're in. And then you go, okay, cool, I'll just keep an eye on that. But there's no need to manage it because what you're expecting to happen is probably still going to take 2 or 3 weeks. So there's no need to check it on a daily basis. There's no need to check it every 5 hours and say, oh yeah, it's gone up 0.5%. Like who gives a shit if it's gone up 0.5%? You're looking at 30%. And you know it's going to take 2 or 3 weeks, so just let it go. But have your alert set to monitor it. Now this
kind
does
of patience really takes a while to get used to.
It does. That's why a lot of people don't learn this to begin with because it's a slower game. Because one trade for 3 weeks, people are like, oh man, 3 weeks, I want to make money now. But you can have 3 or 4 then going at a time. You don't just have to have the one trade open.
And do you think in some ways it might be better for those that do come over to crypto from trading stocks for that reason? Because obviously the stock market, the trades are so much slower.
Yeah, definitely. If we're talking percentages and shit, the stock market can be quite slow. If you're position trading, which is essentially like, taking a position, sitting in it for a month on end because based on fundamentals, the stock is, potentially going to go up or whatever, then you might buy, hold and wait. But if you're actively trading the ASX or even the New York Stock Exchange, then it's going to be really different for you. And you probably will be a little bit more actively trading on the daily rather than letting something take 2 or 3 weeks or a month to play out. But it's a much more relaxed style of trading. Again, like the profits are generally much bigger. Obviously using bigger position sizes, your profits can be much bigger because you're trying to capture much more of the market rather than trying to look for those little moves. You're actually capturing the whole run. But the reason it's good to not keep looking at the charts every day or every 5 hours is because it's like an emotional roller coaster. You'll see your trade go into 20% profit, and then it will come back to 10% profit. Then it will go up to 50% profit. Then it will come down to 12% profit. And those sorts of swings will make you constantly doubt yourself. Like, oh, I should have sold there. Oh shit, it's looking really bad. Oh no, it's all good. It's pumping again. We're up to 70%. Oh shit, I think it's going to dump. I think it's going to, and that emotional roller coaster just messes with your head, and you'll end up doing something stupid like closing the trade early. You'll end up closing a lot less than what you could have had, and you just got to sort of stick to your plan and shoot for your target. And if it doesn't work, it doesn't work. But to combat that, I do what I call trade management, which is generally have points of interest along the way that you would probably take profit. I'll just bring up an example now just to sort of show you rather than just talking about it. So this is just randomly here, basic attention token. So let's just say, for example, we got into a long position here because we thought we were going up. And let's say this is my target. That's kind of where I believe we're going to go. I don't normally just get into a position and then sit here and wait for it to go all the way up here and then close. I'll generally make a few adjustments along the way. So I might sort of look for generally horizontal levels. I go look for fairly significant horizontal levels like this. I might find maybe a supply zone through here as well, something like that. So I've got 2 points of interest on the way up on this trade that I might look to secure profit and adjust my stop losses. So I'll just put a real basic trade plan in here. So let's say, for example, that was my overall target and my stop loss is down under this sort of market structure here. Once we get to this point, I might actually close a small percentage of my position. So let's say I close 25% of my position here, and I might bring my stop loss up just to still under some sort of market structure. You still want to put it into a safe spot, but you're just going to bring it up a little bit, which changes your risk to reward ratio. And then if we keep going up, we hit another level of interest, and I would probably take some more profit there and maybe adjust my stop loss again. The reason I do that is securing profit along the way. You never go broke taking profit. You can look back at it and go, oh, I shouldn't have taken profit in that point. I should have just held because I would have made more money. That's typical hindsight with trading is the worst. Never look back and say shoulda, coulda, woulda. Like you'll constantly be post an analysis of your chart saying you should have done this, you should have done that. The fact is, when the market's running, you don't don't act that way. It's completely different, and that's the emotional game of it. But the reason I like to look for these points of interest on the way up is because we could always quite easily reject at these levels. So you want to secure profit at the levels that we could reject, just in case you are wrong, because you're not putting on a trade here because you know you're right. You're putting a trade on here because you've got a high probability of being right. But a high probability can still be wrong. And you want to be, make sure that you know where we could go wrong, so you know where to get out and secure those profits on the way up. So, by securing profits on the way up, if a trade takes 2 or 3 weeks to play out, you're still sort of securing your profit each day. So if it does turn around and go bad, you've still got something, you're still taking profit, and it's still classed as a win. That's your win ratios up, and you can move on to the next trade. As long as your bag's not going backwards all the time, then you should be sweet. So I do a lot of trade management, which you can do with swing trading. So swing trading to me is like the ultimate relaxed style of trading, because I don't want to have to sit in front of the computer all day, pushing buttons and looking at charts. It'll drive me nuts. Like, I've been there and done that, and it fries your brain. So I like to just take my time with things, see what I see, place a trade, sit back and wait. I might only ever have 2 or 3 trades going at a time, but each trade, if they play out, could be $5,000 to $10,000. If they take two weeks or 3 weeks to play out, it's still a pretty cruisy $20,000 for a couple of weeks' work, when essentially you spent maybe 5 hours in front of the screen. That frees up time to do the things you actually want to do, like take the boat out on the bay and go fishing, or take the kids. Well, you can't do anything at the moment. I'm in Melbourne, so I'm pretty much in prison, but you can spend your time doing the things you really want to do, rather than trading your day job for another screen job. It's not really the goal of trading for me anyway. So that's another style of trading there, swing trading. Position trading, that's more, it sort of falls into the investor category. Someone who sort of, you might be someone who really likes basic attention token. You believe it's undervalued and it may go up, but you probably think it might take a year or so to get there. So you would, take a position, you'd buy some bat, and you would sit there and hold it, and you would ride through the swings. And that's the ultimate level of patience. It can play out with enormous gains. But at the same time, it's very risky. It's very speculative, because, sometimes the gains you're looking at are very unlikely, but, people do it. People have been successful. It happens. But you've generally got to take a position and sit in it in a, pretty shit spot for a long time. You could buy something for, say $1,000. You put $1,000 down. That $1,000 could turn into $500 or $600 for the next 6 months. And you could be sitting there thinking, I've just lost half my money. And then 12 months later, boom, it's worth $5,000. And you just, technically 5 times your money. It's one of those things where you got to have a lot of patience and probably a lot of faith and trust in what you're actually investing in. So it's a little bit different in the crypto market. It's very volatile and very random. So me personally, and this is why I said you hodlers will probably hate me, because I think investing long-term in the crypto market is very, very risky. And I think in a way kind of fucking nuts, to be honest. Like I'm a big believer in a lot of these projects. I like what a lot of them are doing. Bitcoin to me is the king, always will be. But I'm not one to sort of jump into something because they're the latest coin that's doing something that everyone else has already done, but they've got a new logo and they've got a partnership and an announcement coming. So I'm not going to jump in and put $10,000 into something that could probably disappear next month. Like very, very risky. But in saying that, there's a lot of people who make money that way. They jump into some dead project that's worth nothing and sit in a hole for a very long time, and then eventually it goes pop and they can jump out. But you gotta remember there's over 6,000 crypto coins in the crypto market cap, and not many of them go 4,000% in a day. So you gotta, it's what we call shitcoin bingo, which is essentially lucky dip.
Honestly, man, apart from like a handful, I couldn't tell you what half this shit does. I just trade the charts. I don't know what any of the the companies actually do or stand for.
Yeah, I just started like that. I really paid attention to the crypto market, and I was really not completely based on fundamentals. I still use technicals to trade, but I was really interested in what a lot of these projects were. But after seeing what happens when we go into a bear market and understanding how their token allocation works and things like that, you start to realize that a lot of these are just like cash grabs. That's all they are. They're clones of each other. They all do the same shit. They all promise something different. But at the end of the day, they've printed a coin out of thin air and they've put a shitload of them in their pocket and then told everyone to buy them off them for X amount of dollars. And that's what gives them its value. And then people trade on the speculation. But at the end of the day, someone has printed coins out of thin air, told you they're worth $1 each, and has got, you know, a couple of million of them sitting in their back pocket that they can just sell whenever you want. It's absolutely insane. But, you know, a lot of people don't think about it that way. They think of the project and their partnerships and the advisory team and who's talking about it and how many Twitter followers it's got and shit. So, look, I don't want to like really put a downer on crypto. I think it's amazing. There's a lot of cool stuff out there, but not a big believer in going deep on investing in crypto. That's me. I like trading it. As a trader, I love volatility and crypto's volatile. So it's good. Hopefully I didn't piss anyone off there. There's probably going to be some people hurting or thinking I'm an asshole right now. I get it a lot.
Well, if they're here to learn how to trade anyway, man. So if they're caught holding bags, then hopefully we can help teach them to actually, you know, grow their Bitcoin stacks and get out of their bags.
And look, man, I've been there as well. I was there. I was hodling bags of shit that someone told me was going to be.
I was there.
Yeah.
We were
Verge,
talking way back in the start of 2018.
Not selling Verge till it gets to $1. Well, it got to what, like 10 cents or something, and then it went down to less than a cent. You know, like hopes and dreams. A lot of this stuff.
At the April Pornhub moon.
Yeah, big partnership now.
The moon.
Yeah, it's always something. Yeah. Anyway.
Well, maybe for the beginners, like I know Simon put in the comments there that he's completely new. So maybe we could do a quick tutorial on sort of showing how to read the charts, how to understand what the candles are, the different time frames or whatever.
All right. This is I'll do a really, really basic tutorial right now on candlesticks. And this is probably still something that a lot of you guys who probably know how to trade probably haven't looked at candles in this way anyway. So this is just a way that I like to explain a candlestick.
For those of you that do already know this stuff, just try and bear with us. We will get to more sort of advanced stuff as we go, but we do need to also sort of cater for those that don't know as much as what you guys know. So just hang in there.
So where's my that thing's hidden over there. I'm going to pull that over here for a second. So a real basic construction of a candle is something like this, right? So this is the body of the candle, and these are the wicks. You can see here we've got all different types of candles. We've got ones with small bodies, long wicks. We've got little wicks, big bodies, wicks to the top, wicks to the down. We got red ones and green ones. What the candlestick's actually doing is telling us a story, what happened in that time period. So that's something where a lot of people who do know how to trade probably haven't really thought about it in this aspect. A candlestick is telling you a story of what happened in that time frame. Oh, yeah. See you later, Shams. It's all right. Just a mate was messing with me then. So we're on the 4-hour time frame right now. So you can see here 4H. That means every candlestick we're looking at is a 4-hour trading session. So you can see the current candle we're on right here. We've got 2 hours and 28 minutes left until this candle closes, and then pop, the next candle opens and we start moving on to that. And then that candle will start building and telling us a story. The further you zoom in, you can start to see exactly what's actually going on inside that candle. But when we're looking on, say, the 4-hour, we want to know what story this candle here told us. So what this candle told us is, so the bottom, so on the sake of a green candle, the bottom part of the body is where the price started. So when this candlestick opened, this 4-hour session opened, the price started here. Now, at some stage during this 4-hour session, we got down as low as this. We got as high as this wick, right? That's the bottom of the wick. That's the top of the wick. But then by the time this session closed and we moved on to the next candle, we came back down to here, and we closed there. So essentially we started at 1120 and we closed at nearly 1200. So you can see here, I've just drawn a little bit of a timeline here. So essentially this candle went like this, like a heartbeat pulse thing. So it's just told us a story of what happened in that period. Now, when we jump down into smaller time frames, you'll probably see that the candlesticks went something like this. Yeah, because that's essentially what this candle is doing. It's wrapping it all up. And then at the same time where we see this sort of thing here, if we could bundle all that up into a candle, what we've actually seen is price started here. It got as low as here. It got as high as here. And then it closed here. So essentially we could wrap this up in a candle that looks like this, a body with a big wick here and a big wick there. Yeah, that's essentially what a candlestick's doing. It's telling you a story of that time frame. Green generally means the price started here and ended higher. So the price went higher in that session. And a red one, vice versa. The price starts at the top of the candle and it goes down to the bottom of the candle, the bottom of the body. So red means price went down, green means price went up. It's pretty simple. Really, really basic stuff. So does that sort of make sense to you guys about how a candlestick works? Like what a candlestick's doing, telling us a story of price action within that period? You know, they'll always be different depending on what time frame you go on. It'll always tell you, you know, obviously just a different time, what happened in that, you know, longer time period or a shorter time period. Then where we go from there is we've got all different shapes and sizes and lengths of candles, and they all tell a slightly different story as well. So when we see something like this green candle here, it's got a really big wick to the downside. So even though the body's only small, but there's a really big wick here, that means that the price dipped pretty low. So the sellers came into the market, but the buyers were so strong, they pushed the candle straight back up and, I've got to put my pen back on. We pushed straight back up and ended up closing higher. So we came in, we got low and we closed high. That is what I would call a super bullish candle. Like it's very, very bullish. Bullish meaning, you know, there's a lot of buyers in the market because the sellers came in hard to try and drive the price down. But by the end of that session, the bulls were leading the fight. They pushed the price, they rejected it from down low, they've pushed it way back up, closed high, we're going up. So that candle could, that single candle there could indicate that price is probably about to go up. So you could almost base a trading decision just off that one candle alone. However, using a single candle by itself is never really the best indication because it doesn't give you enough confirmation, because you can always have a candle like this and then the next one's a big red one, right? Ideally, you want 2 to 3 candlesticks for a confirmation. Now, it doesn't mean you want 3 green ones in a row, although that is a pattern, 3 green soldiers, I think it's called. You can get different combinations of candles that can tell you what things are going to be. I'm not going to go into the description of every single type of candle because there's absolutely tons of them.
I'll post something on Facebook later on, guys.
Yeah,
I've
it's
got
like
a little
a
cheat sheet
sheet
on
or
there
something,
for
yeah.
you to show you the different types of candle patterns.
I'll try and find. I was going to work with this here, but it's not quite exactly what we're after. But if we can ignore this little green wick or this little doji here, and we just look at this bearish candle and then a doji and then a bullish candle, this is typically what we call a morning star pattern. Excuse me. So what this is telling us, we're in a heavy downtrend, okay? And then we've sort of stopped. We've had an indecisive candle because a doji or a spinning top, which means we've got a fairly large candle, but with a very, very small body. So what does that tell us? What is a candle that, you know, has a very, very small body like this? What does that sort of tell us? Big wicks, small body.
It's indecisive.
Because it started at whatever price. It got down very low, got up very high, but it closed at almost the exact same price. So within that 4-hour period, you could almost say the bulls and bears didn't know what price we were going to be, and we ended up closing at the exact same price. So essentially, you could write off that candle like nothing happened. It's an indecisive candle. The market doesn't know whether it's going up or down. So when we've got big red candles, we know the market's going down. Then all of a sudden, we get indecisive candles to say, I don't know where we're going to go, up or down. If the next candle is a big, we're going up candle, we've got 3 candle confirmations there. You've got red candles telling us we're going down. We've got an indecisive candle saying we don't know which way we're going, and then a green candle saying we're going up. That's like a big bowl. They call it a morning star pattern. You normally see these at the end of a downtrend. So if we've got a heavy downtrend and we see a morning star configuration, there's a good chance we're going up from there. So you can use those 3 candles as an indication of where we're going. There's lots of different patterns like that. A lot of people use bullish engulfings or bearish engulfings. I'm not a big fan of those myself. I prefer to use a 3-star pattern or three candle pattern. But a bearish engulfing and a bullish engulfing are used a lot, which essentially means the next candle engulfs, the body engulfs the last candle. So this is a little indecisive doji or a spinning top here. So the body of this candle is very, very small. The next candle absolutely dwarfs it. It engulfs the body. That is generally a bullish sign as well. So, you might base a decision off that. So that's just a really basic description of a candlestick. What it is, what it's telling you a story. And there's you'll have to have a look at the cheat sheet that Dave puts up. There's obviously lots and lots of different types. They all mean different things. But you don't have to go right into it. You stick to the basics. And actually, I believe they've actually built a new, here we go. All candlestick patterns. There we go. So TradingView have actually built, I don't know if this does them all. I haven't used this much myself. But TradingView have built a new indicator that's just built into the software now. And it actually tells you exactly what type of candle it is. So it does the hard work for you. So that's basically saying a bullish engulfing, BE, bullish engulfing, BE, bearish engulfing, D, what's a D? Doji. There you go. So this almost tags the candles for you. Noda, it is in, if you go to indicators and in here you got candlestick patterns. And if you just click that one, it'll throw them all up there. I don't know how accurate this is. Like I said, I haven't used it much myself, but. So we got what's the H? H is a hammer. Hammer is when we've got like that big long wick. So, they call it a hammer because essentially it looks like something like this, like a big hammer. You got a handle with a big hammer on the end of it. So that's what a H is there. Like I said, you'd have to scroll through to see how accurate they are. But, if we scroll in here, we can see here that BE, that bullish engulfing it's looking at. You can see here it engulfed the size of that candle. This is pointing to that little doji. That's a bearish engulfing because that engulfs the length of that candle.
That's basically the opposite of the pattern that you were talking about before.
Yeah, this is called an evening star pattern. So you know how before we were talking about a bearish candle followed by a doji followed by a bullish candle? Well, this is the opposite. We've got a bullish candle. We've had a bullish run up. We then get a doji and then a bearish engulfing. That's telling us the price is going to reverse and come down. So those the morning star and the evening star, they're ones that I use religiously as really good reversal tools. And I'll get into that in a second with some of the strategies I use because they can be great for entries and exits, as long as they sort of coincide with something else you're looking at. So for example, an evening star, you really want to find an evening star at the top of an uptrend, in a significant uptrend. And you want to even look at like horizontal levels. So if you see something like this and you look over and you find that it lines up with a perfect horizontal level, so you've got an equilibrium through there, you can go, okay, we're on a nice uptrend, right? So we've gone up, we've hit a level of resistance, we've built an evening star pattern. You've got like 3 confirmations there that we're probably going to go down from that level. And that can give you a really good indication if it's time to get into this market and short it, because we've had a long run up, we've hit a level of resistance, and then we've had an indecisive candle followed by bearish engulfing. You've got 3 or 4 confirmations there that we're going to go down from that level. So you'd take that short down, and then you might be looking to take profit at significant levels as well. So you might be looking at this previous bottom down here, and you might be looking at something like that. So you might have taken profit on that first jab there, and you might have gotten a close down there at the bottom of those closes. So yeah, there's some really easy ways that I use those sort of candlesticks. Like I said, try to use, if you're going to use candles, candlestick patterns, try to look for like 2 to 3 bar patterns. Don't base it off a single candle like, oh, a doji, I'm going to short, or oh, a doji, I'm going to go long, or bullish engulfing. You've got to see it in the right spot. A bullish engulfing excuse me, a bullish engulfing at the top of an uptrend is kind of madness to long. Like, even though it's technically a long signal, if you're already in the top of an uptrend, why you're literally buying the top of the market? It's already moving up. You're not buying it. You should be looking for reversal patterns to potentially short it, or you should be looking for pullbacks to get into a good position to long it. And we'll look at some
find good entries and sort of getting in and out of a trade. What do you look for sort of in the candles, so these guys can get a bit more of an understanding of the patterns that you're seeing and how to implement that into a trade?
Yep, perfect. So let's say, for example, you missed this run, right? It's already started to head up. You've missed it. You didn't get into this trade, but it's pretty bullish activity and you want to get into this trade. So you want to get into the pullback. So what we've seen here is we've seen some exhaustion because we've got a big bullish engulfing candle followed by another bullish candle. Then we've got this inverted hammer. So you can see how this is a hammer, but it's upside down. So that's a very big bearish signal, all right? So not only is it a bearish candle, like a red candle, which means the price went down, it showed us that the bulls tried to push the price up, but the bears just smashed it straight back down. So that's a strong bearish move. We had another big wick to the upside. This is another bearish move, right? Now, if you jumped in on this bullish engulfing because, hey, we're going up, right? You're buying a bullish candle at the top of an uptrend that's already showing signs of exhaustion. There's other things you could use to try and find signs of exhaustion. So immediately I would look at this and go, I don't think this is going to keep going up. I think this might pull back. I want to find the entry on the pullback. All right. You want to trade with the trend. The trend is up right now, but you don't want to buy the top of the market. You want to get a good entry. So you want it to pull back so you can get into a better entry. Fibs is your staple. You're always going to use Fibonacci. For you guys who are new with trading and don't understand what Fibonacci is, it is a mathematical equation, sometimes referred to as the golden ratio, which is virtually a series of numbers that you multiply by the previous number. It creates this golden ratio that's actually, it's quite amazing. It's found in like all forms of life and biology. It's actually quite amazing the way it works. The reason we use it in trading is because this crazy phenomenon with this ratio is it's heavily based on human emotion and reaction about what we want to do, where we want to do it, and when we see the right time to do it is, which is generally why Fibonacci works. There's arguably another reason why Fibonacci works is because everyone's using Fibonacci, everyone's using those levels as entries and exits, and that's why the market reacts that way. Again, based on human emotion, because we know that other people are going to be thinking the exact same thing, and they're probably going to want to do the same thing as well. So it's a bit of a phenomenon the way it works. Now, these numbers that I've got marked out here, the 236, the 382, the 5. Now, 5 is essentially a 50% retracement. The 50 is not actually a Fibonacci number. However, it is a fairly significant number. We generally pull back to that level. It is respected in the Fibonacci basis, but it's not an actual Fibonacci number. 618, 786, so on and so forth. All right, so we've got our levels of interest that we might be looking at. Now, what I generally do is go back and have a look to see any sort of levels that I think could be fairly significant. All right, so I use my horizontal tool and I want to look for what I call equilibriums, which is essentially horizontal levels that have been both support and resistance. I'm sure you guys understand what support and resistance is. What we're looking for is, resistance is basically where a candle's closed. This would be resistance here because we've come up, hit that level, we've closed and then come back down. Some people will draw resistance on wicks like this. You can see here we've hit this level, rejected. We've hit this level, rejected. We've closed here. So that could be a level of resistance. I like to use equilibriums because I like to find points where price has been respected as both support and resistance. So you can see here, it was respected as resistance. We got rejected. It acted as support here. Lots of bounces off this level. So we know it was significant back here. We've broken through, tested it as resistance here. Resistance again, support, resistance, support, resistance. This level has been respected for some time. So I like that level. Okay. So then I'd come across and go, how does that line up with my Fibonacci? It's a little bit lower than the 618. Now the 618 is the ideal spot that we want to buy. It's going to offer the biggest reward because it means a really nice deep pullback that we can get a good run up on. However, now this is a little bit of controversy here because we've got what's called the golden pocket. Now, the golden pocket is technically between the 618 and the 786. Actually, I think it's a little bit twisted to that as well, just after the 618. However, what most people refer to in trading is the golden pocket, meaning like the best spot.
618 to the 65. No?
Oh, there you go. Sorry, 618 to the 65.
65. So 618, guys, it's a 61.8% retracement.
Retracement, yeah.
So then 6.5% between those two, that's your golden pocket.
That's right. So this would probably almost be the golden pocket there. But the way that most traders will look at it is sort of between the 50 and the 618. So this here that I've got marked out in the green, that's kind of like what you would probably call your buy box. Right, that's your buy box. Anywhere in there is considered a good time to buy, whether it's right at the top, right at the bottom, in the middle. It doesn't matter. This is just a general rule that anywhere in that box is probably going to be a good spot to buy and hold to make sure that we bounce off that level. If we bounce off that level, we're good. If we don't bounce off that level, you probably, you want to get out. It's not going to work. So I would come across and I'd see this significant level that I've already seen. It sits a little bit lower than where I reckon I should buy. So I might just adjust that up and say, you know what, the 618 is probably going to be a good buy. It's pretty close to a level that I'm interested in. And then, what I would do is generally split my entry up into two or three. So I might go 50% at the top of this entry, of this box, and another 50% at the bottom of the box. The reason I split it is the market is never 100% accurate. You'll never do the most accurate TA and get entries to the dollar. And it happens every now and then. If you tried to get to the dollar every single time, you would miss a lot of entries. So don't get too picky about trying to get that perfect entry on the 618. So what I do is I split my entry up. So let's say if I had $1,000 to put on this trade, I would put a position of $500 here and another $500 down here. So that if the market does pull back, hits this, I get $500 into the trade. And then if it starts to go up from there, I'm sweet. I got $500 in the trade at least. That's something. If it pulls all the way back and I get completely filled, it means my average entry is basically halfway between these two, and that's my entry, and I'm good to go. However, if I put my whole $1,000 down on that 618, what's the chance we pull back to just about the 618 and then we rock it off like that? And you think, I missed this by like 20 cents. What an idiot. And then you start kicking yourself. Yeah, and then you start following it because you're like, oh, I missed it. This is a good trade. And now it's going off. So you start moving your trade up and then you end up buying up here like a schmuck anyway. So, don't get too optimistic, but don't get too greedy or anything like that. And just, that's why I do those split entries. So I'd put an entry there and an entry there, and I'd be happy with that. I'd think that's a pretty safe bet. I'll just push play and see how this goes. Hopefully it doesn't make a liar of me. Where's my play button? There we go. Boom. All right. So that's a perfect example of why splitting your bag's a really good option. Because if you had your trade down on the 618, because lo and behold, 618 is where you want to be buying, well, you would have never got that entry filled. Now, I would have only got half of my entry filled, but half is better than missing the trade and buying it like an idiot up here. So that was a pretty good example just then. So that's one of the most basic ways I use to find entries, Dave, because I like trading with the trend, and this is trading with the trend. The trend is up, but I don't want to buy the top of the market. I'm not just going to, you'll hear a lot of people shilling out these shit coins to you. Oh, Link's on a massive run. Buy Link. Link's going to be $20 or whatever. If you just go buy Link at any stage, you're likely to see it pull back straight away and then go, oh shit, I'm 10% down. I'm 15% down. Sell. That's literally the, well, you see the jokes all the time. Buy high, sell low. Because that's what happens when you don't know what you're doing. You'll buy at a silly price because everyone's talking about it. And then it pulls back, you shit yourself and you sell it. Buy high, sell low. It's literally the opposite of what you're supposed to do. We sometimes refer to buying the blood.
Sort of listen to Donny and to learn this sort of stuff. This is different to listening to those that are just saying, everyone go buy this coin. That you're just going to get destroyed doing that.
You will never hear me shill a coin to you. Yeah. I will never tell you to buy anything because it's the worst thing ever. It takes you back to 2018. Yeah.
Yeah.
You'll probably hear it referred to as buying the blood. Always buy the blood. Like when there's blood in the streets, you go shopping because there's always going to be a recovery. Yeah. You're buying off all the panic sellers, all the people who are going, oh shit, a big red candle, I'm going to sell. This is going to go down. I'm at the other end going, yeah, give me them, because it's going to go up from here. You're just freaking yourself out. And that's the psychology side of trading as well. It's a game of patience and, what do they call it? Like a transfer of wealth between the impatient to the patient. The impatient ones are the ones who are panic selling and panic buying, and the patient ones are the ones who are sitting back saying, "You're an idiot. Give me your shit. I'll write it from here." That's kind of the whole patient versus impatient thing.
And the patience runs both ways, up and down. Like if the market's going down and you've got a buy order set for a pretty low zone, you got to be patient to let it hit that.
Yeah, and just wait. Let the market come to you.
On the flip side, if it starts mooning, a lot of people, they all start buying in, and that's FOMO, fear of missing out. Patience to wait for the retrace as well. Like that's, it might go $2,000 higher and whatnot, but you're not going to win all the trades. Just having patience up and down is important, I reckon.
The biggest thing to remember about FOMO, which, as Dave said, fear of missing out, you got to think of what that is. Fear of missing out. Everyone has this idea that they're missing out on the next Bitcoin run. Like every trade's going to be that next 5,000% trade, and you're going to miss it. You're going to be that one guy who's not holding some shitcoin that everyone else is holding, right? That's the fear that every trade is going to be this next amazing trade. The thing is, you make money on volatility, and every day something is moving and you miss out. So when someone says, oh, did you catch OMG? OMG did 30% the other day. Did you catch it? Did you ride it? And you're thinking, oh no, I've got to go look at OMG. I missed it. Who gives a shit if you missed it? I can go through the ASX right now and show you a shitload of shit that you missed. I can show you everything on the New York Stock Exchange that you missed. I can show you all these commodities, oil and gold and everything. You missed everything. Because the fact is, you can't trade everything, and something is always moving. Don't be afraid of missing out on this one trade that your mate caught. Who gives a shit? Give your mate a pat on the back for making 30%, all right? But don't think that you've now missed out and you're not going to be friends with him anymore because you didn't catch OMG either. Just catch the next one.
It's not going anywhere.
It's not going anywhere. It's going to be here tomorrow. Someone says, oh, did you catch Bitcoin? Oh, it's never going to come back to 6,000, isn't it? Oh, I've missed Bitcoin at 10,000. I'm never going to be able to get Bitcoin again at 10,000. Look what happens. A month later, we're at 9,000. It's just wait. Let the market come to you, and don't be stuck in that mindset of that. If you don't get this trade, it's all over. Because it's not all over.
Yeah, there'll be another trade tomorrow.
Yep. But that's trader mindset versus investor mindset. So an investor may have that sort of FOMO about never getting into a trade at the right price. Like Bitcoin, for example. An investor might look at Bitcoin here and go $9,500. Oh shit, I better buy it now because it'll never be cheaper than this ever again. That's an investor mindset, right? A trader mindset doesn't really give a shit about the actual price of the asset. We're just trading the volatility. There's a lot of the times I don't give two shits what price Bitcoin is. I couldn't care less if Bitcoin goes from 12,000 to 16,000 or 12,000 to 5,000. I'm making money on the volatility, so I don't really care what price Bitcoin actually is. I jumped into Tesla the other day. Tesla's at the top of the market. It was a dumbass move, but they announced a 5-to-1 stock split. So I know there's going to be a lot of FOMO in that when the stock split comes and the price of the stock drops. There's going to be a lot of retail investors finally able to invest into Tesla. So I'm expecting a big pump there. But I don't give a shit what price I bought Tesla at. I'm just looking to make money on the volatility. I'm not looking to invest in Tesla long term because it's at a really shit spot. If I was going to invest in Tesla, the time to invest in Tesla was a few years ago when it was a lot cheaper than what it is now. Buying it now is kind of ridiculous if you're looking at investing.
You don't want a Cybertruck, Donny?
Sorry, bro?
You don't want a Cybertruck?
No, not really. I think they're absolutely ugly as shit. I'm sure that's a joke, yeah? Like, that's not actually happening, is it?
I don't know. I hope not.
I hope not as well. Probably bankrupt the company. But yeah, that's kind of the difference between an investor or a position trader and an investor or position trader versus, say, a day trader or a swing trader like myself. I don't care what price I'd buy VET at is if I can make 10, 20% in VET, I'm buying it. I don't care what price it is. XTZ, I don't care what price XTZ is. I'm just looking to see if I can make 20, 30% on it. If I can make 20, 30%, I'm in. I don't care what price it is. It's irrelevant. So that's another thing that you can get into a habit of with fear of missing out, because it doesn't matter what price you're getting in. You're just trying to catch this volatility. But if you miss this one, don't worry. There's another one to look at. There's another one over here. There's 6,000 shitcoins in the crypto market to look at. There's always something. So don't get too hung up on trading a specific coin. I was just going to push play and see what actually. So what we would do here, because I talked about an entry here. I didn't necessarily talk about an exit. So what I would probably do for an exit here. So we've gotten into an entry on this pullback. We're happy with that. Now I mentioned before about having points of interest on the way up that I would consider taking profit. One thing I always do on a pullback is look to secure some profit at the previous high, right? Because the previous high can always turn into a double top, which is a reversal pattern, and then we start heading down. It just means the market's not ready to go up yet. Like it means, we've had some bullish activity, but there's obviously a lot of sellers at a specific horizontal level, and we're not ready to go up. So I always like to make sure I can secure some profit at the previous high. So I'm just looking at, we've moved up, we've hit a level of resistance, pull back. I've got my bag filled. I'm looking to take some profit here. May not close my whole position, but I'm looking to at least take some profit. Then,
what sort of percentage would you take, Donny? Like if you've got your,
it depends on the setup.
So you've got $500 in your trade. What percentage of your 500 would you put in for a TP there?
Look, it depends, anywhere between 25 to 50%. Normally my first take profit is 25%. I normally just work on 25, 25, 50 with everything, even with entries. Entries is always 25, 25, 50 or 25, 50, 25, mix it up a bit. But I normally just work on those few things. So that first take profit would generally be about 25% of my position. Yeah, so that does a few things. It's just easy to work with, man. And I've got OCD with round numbers as well. So I've got a position size calculator I built that will tell me to buy, 5,674 contracts. I will not buy, I'll buy 6,000. I have to buy 6,000. And when I go to sell, I'll have to sell 2,000 contracts. Like I have to do round numbers. It's to the point, like when I was trading on Binance, I had to have tons of BNB because like with the fees and shit, when you're trading on the alts, you would go and buy, 50 Neo, right? But then it'd eat some of your Neo in fees. I'd have to go and buy more Neo. So I had 50 around whole Neo. So I started stockpiling BNB to use my fees. I'm terrible with that shit. But anyway, so that's my first point of interest. That's where I first want to take profit. The other point that I want to take profit, I like this little wick here, all right? And then if we go left, it actually matches up to a perfect candle close on here, which was our previous high. So that's another point that I'm pretty keen on taking profit. Always look left. You'll hear that like all the time is always look left. Always look left for previous price action. It'll generally give us a good indication where we think price may go. So normally take profit 25%, take another 25%. I've got half of my trade left on. So let's say I've got $250 left on. I can let this run. The first sign of bearish sentiment, which is, a big wick and a bearish candle opening, I might get out there. That might be the last bag that I get out. The reason I like to take profit in those sort of points like that, it does a few things. One, it locks in profit. Two, it reduces your exposure to the market. Now, this is big because I leverage trade and I use like a lot of high leverage. I don't enter on high leverage, enter on lower leverage. But when I increase my leverage as I move on in the trade, I actually reduce how much capital I actually have on the trade. So as an example, I would enter a trade with say $1,000 or $2,000 on a trade of my own money that if I get liquidated, I'm going to lose $2,000. All right. But by the time the trades move to my first take profit and I've maybe taken 250 or, what did I say? $2,000. So I've taken $500 off the table. I'll still have $1,500 of my own money. Straight away, if I move my leverage to maximum, all of a sudden I've reduced my capital input down to say $700 or $500. So essentially I put another $1,000 back into my bank account. However, I still have the same size position. So I still have a position size of $1,500, but I've only got $500 of my own money on here. So you can imagine now, if this turns to shit, I'm only going to lose $500, but I've already, taken my money back off the table. And this is how you reduce your risk or reduce your exposure to the market. When we go on and take profit again, all of a sudden I close another $500 worth of position. All of a sudden I have no capital input in the trade, and everything that's left there is free money. So I'll essentially still have $1,000 position, but I'll have no of my own money on the trade. So if I close right now, I lock in $1,000 profit. If it keeps going up, I make even more money. If it turns to shit and hits the deck and I've got a stop loss in profit, I might take $500. But that way I can't lose. You get to a point where you can't lose. And whatever happens in the trade is just free money. You let it run. If it keeps going, you're laughing. If it turns around, you take however much you take. So those 3 points, I would have taken profit. Profit here, probably closed on that first sign of a bearish candle, because now we're looking to maybe buy back in. All right, so we've seen that rejection. Now we might go and draw fibs again. All right, you always expect at least 3 sort of impulse moves. So where are we looking, guys? Kill, yeah, I'm recording this, man. Yep.
See you later.
Can anyone sort of have a guess where we would be entering here?
Stephen, I'm going to put you on the spot.
Paul, 9392, 9392. Where's 9392? 9392.
It's right at the 618.
Boom. Jesus, how'd you pick? Oh, you're looking at the 618 there. You cheeky bastard. You got me, good one. Yeah, probably between here and here. That's our golden ratio again, or golden pocket. We're looking to try and, probably split our bag up into there as well. Now, this might be a good example of we don't actually get hit, because it kind of looks like it's almost turning around here. So we may not actually get hit here. But what are we doing if we don't get hit? We missed it. But what are we doing? Gary nailed it, 38.2. We got to hit on the 38.2. Leaving it. That's right, Paul. We're leaving it. We just didn't get our entry. All right. So we're not going, shit, it's mooning. It's going to go. Oh, no, Bitcoin's about to go to $100,000 and I'm not holding any. Got to jump in. No, we're just going, shit, I missed it. And then I'm going to go look at ETH and I'm going to try and find something on ETH. All right. That's what you do. When you miss your trade, you don't chase it. You go, I'll look at that tomorrow and go jump into something else. Because you got to remember, there's a lot more shit to look at. You don't have to sit there looking at Bitcoin the whole day, or Ethereum or whatever else you're trading. You have to sit there and keep watching the same thing over and over. If you missed an entry and you say, okay, this has now got time, this now needs to cool down and do something, go look at something else. That's where we were there. Well, you definitely missed that moon. So you pretty much missed out on a rocket ship there. Let's have a look at something else. Vet. I think the missus was having a play with some stuff today. She's looking at doing a few basic trades. Ethereum. What happened with Ethereum? Okay, this is half decent. So this one, what was she looking at here? Okay, so she's got fibs drawn from the bottom of this pullback up to here. We've got this pullback. So she's got an entry on the 50 and the 618. But I think what she was looking at was this price point here. So looking at the previous top, lining up with the 50, expecting us to hold here. And you can see here we've double bottomed on it as well. So yeah, it is recorded, mate. I will let Dave work something out here. I think by the time we finish this, he might upload the recordings or something once we finish all 3 parts.
Yeah, once we finish all 3 of them, I'll put them together.
Yeah, cool. So you can see here we've had a big pullback, but we've now respected this level twice now. We've touched on the 50. So that might be a good point to enter. I think she did enter on that one today anyway. So that one's got a little bit to play out. And XTC was the other one. This was actually one that I did a couple of weeks ago, I think. I can't remember now. But that one's following suit pretty well. But I don't know what she's doing with that one. SXP. These are all... I'm going to start again with these things.
Hey, can you run a fib from the top of that to
top down?
like a bearish fib?
Yeah. So I probably should mention that as well. So before, when we're drawing our Fibonacci lines, we're going from the bottom of a pull, bottom of a push to the top of the push, right? And then we're looking to buy those retracements.
Look where that landed, guys. Look at that retracement.
Yeah, boom. And you see how it respects other Fibonacci levels as well. So you can see even, actually what I'll do is I'll replay this so you can see every time it hit one of those levels, it respected it. So I'll go back to here. I'll zoom in a little bit so we can see it a bit better. And if I push play, you'll see, bam, see that? We hit the 38.2, right? And then we came back over and look where we closed on the 23.6, or sorry, 0.236. Come back down again, bounce off the 50, bounce off the 50. Now we're getting rejected on the 38. Coming down a little bit lower, didn't quite get to the 618. Oh yeah, it did get to the 618. You can see how it's being rejected on the 38.2. So it sort of respects the levels as support and resistance. When we come down, we bounce off it. When we hit it, when we go up, we hit it as resistance. So as much as you can draw Fibonacci on the way up to find retracements, you can also do it on the way down. But if we're looking for retracements on a downtrend, we need to start our Fibonacci from the top and work our way down to the bottom. So you draw it the exact same way. And if you have a look at that, look where our retracement came up to. Bam, right on the 50. You can see here how it respected the 23.382. And you can see here how it also respected the 236. So Fibonacci works on the way up as a retracement, and it works on the way down as a retracement on the way back up, like that. So that can be a really good way to find entries if you think this trend is going to continue. So we've had a really
just pretty much trade just on Fibonacci. Like that's
a lot of traders just trade Fibonacci alone. Most of my strategies all use Fibonacci. You can see here we've had this massive run, which was, let's just have a quick look and see how much that was. 200%. So we had a 200% run on SXP just recently. I think Binance bought them out or something like that. But then we've had a big sell-off. So obviously some of the developers or whatever inside trading is sort of dumping their bags. So if we still keep heading under this downtrend, then you could have used these Fibonacci levels as points of entry for a short. So 38.2, the 50 and the 618. You could have been looking to take an entry anywhere on these levels here with the intentions of writing it down, probably back to where it started, like that. So yeah, that's another way to use Fibonacci on the way down rather than the way up. If that makes sense. Cool. Thanks. Was wondering. Same. Okay, Lee. I was also wondering if you offer help for fee. Lee, that's something you'll have a chat to Dave about that if you want, man. I'll tell Dave to get in contact with you after this. What else do we want to look at, bro?
So maybe you guys got any questions, anything in particular that, you might have seen in the various Facebook groups that you're in that you've always wondered, what does that mean? How does that work? It doesn't matter how basic it is. There's no such thing as a stupid question. If there's anything that you'd like to know specifically, now's a good chance to ask because, as you've seen, Donny's very knowledgeable. We've both been in the crypto space for a number of years now, and we've both been trading it for quite a while. So if you've got any questions, just put it in the chat box and fire away.
It might be worth, I'll make a form on the weekend.
Yeah.
And I'll pass it over to you, Dave, and I'll get you to post that in the Crypto Den community. Yeah, and that way they can click the form and ask questions and stuff. And then that way on our next session, we can sort of try and squash a bunch of those questions.
Yeah. So not a real name. As it, haven't really used trend lines any particular reason.
Yeah, look, I've never been big on trend lines. I've started using trend lines again to show people, like I honestly don't normally draw on charts. I just look at charts and make my decision. But because I teach a lot of people, I have to draw stuff on the charts to show them what I'm looking at. So I don't normally draw much on charts to begin with. And when I do, they look terrible because I just scribble on them and shit just to show people where I think it's going, basically. But I've started using trend lines a lot because I've started teaching a lot more newer, new people to the scene sort of thing. And trend lines is one of those like real basic staple type things that you should use. I don't use trend lines as much, but I do use market structure, and they kind of both do the same thing. The reason I don't really use a trend line so much is because a trend line is normally used for a form of breakout trading. And I typically don't really do breakout trading. I find it not a very profitable strategy for myself.
And if you missed last week's session as well, Donny does touch on this to say that he's more of a range trader as opposed to a breakout trader. So when we do release the recordings, make sure you watch number 1 as well.
Now, the other thing I don't like about trend lines is they're what you call subjective. Everyone will draw them differently and they constantly change. So it's very, very hard to base something off something that's constantly changing or what everyone's seeing something different with. To give you an example, I'm just going to draw like a trend line that I can see straight here, right? Now, because some people draw trend on candle bodies. Okay, so I'm looking at these bodies here. There's bodies here, there's bodies here, there's bodies here, there's bodies here, bodies here. So someone could draw a trend line like that. However, there's some people, like if I draw a trend line, I use wicks. So I'm looking at wick to wick. So I'm drawing a trend line like this, wick. That one's a bit of an anomaly. Wick, wick, wick. Yeah, you want to have, say, 2 or 3 touches at least within a trend line. Ideally 3. You want 3 points to line up in a line. That'll generally give you a good indication of a trend line. So that's 2 different ways people can draw that trend line. Now, the other thing is, this might be a really bad example. Yeah, it's not the best example. Or actually, what I'll do is I'll draw a trend line on top of the chart here. It's not ideal, but let's just reverse this back a little bit. Let's go to here. Whoop. It's frozen. Oh, there we go. All right, so we're going to draw our trend line there, right? That's our trend line. Now, if you come and look at this today or this day, there's your trend line, right? Now you go to work and then you come back from work and then all of a sudden, hang on a second. All right, so then you come home from work and then you look at this and now all of a sudden you go, well, hang on, this is the trend line. See what I mean by the different time you look at it, the trend line's constantly changing. Now, which one's right? Which one do you put more weight on? Yeah, out of these 4 trend lines, which one's right? I mean, they're all sort of going in roughly the same direction, right? But if you're going to be using a trend line for something specific, like a breakout trade, you want to see that trend line break to give you an indication of jumping into a trade. So which one do you use? Do you use this one? If we break that, are we shorting? Because what about if we break this and you start shorting, but then we hit this and bounce off there and we just do one of these wicks? Then you're really wrong. All right. But if you use this one as your break, then, what happens if we wick down just a little bit further like we did on this one and we just create another trend line and then we start heading up again. So I'm not a big fan of breakout trading because I don't really like trend lines that much because I find that they just change and change and change. A really good example of that is Bitcoin on the higher time frames. It's probably better off here. This is probably a really good example when I realized trend lines are, I'm not going to say shit. They're like staples. They work, but
they help you see the market structure, the way the market's going, if anything at all.
So if we went and drew a trend line like this, all right, originally, because I'm going back in time here when we're treading water through this mess here. We started to break out here. So what does everyone do? Oh, we're bullish. We're breaking out of a downtrend. Go long. We're going back to 20 grand, right? Everyone assumed we're going back to 20 grand. Then what happens? All right. We hit a bit of a speed and we start again, come back down. So now all of a sudden we go, okay, that trend line's wrong. Maybe it's this trend line. All right. So that's our new trend line. Okay. And then we push play again. Maybe we should have sped this up a little bit. All right. Oh, we've broken our trend line again. So we're going up, right? We've broken this downtrend. We're out of our bear market. We're now going back to 20 grand like everyone said we are. And then what happens? Actually, I'll point this out. Let's just draw Fibonacci here. Have a look where we are.
Pretty much do that on every single top throughout 2018.
Yeah. So I probably should draw another trend line now because there's another trend line there. Then we broke out of it again. All right. Then we push play. Oh, not push play then. There we go. Oh,
Starting to
I'll draw another trend line now. So which one of these is right? I want to speed this up. Oh, we've broken out again. All right, so we've destroyed our bear trend again, and now we're going up again. All right, up to the moon, up to 20 grand. Oh, no, not at all. That's just another downtrend. All right. And we're just going to keep drawing these downtrends. Oh, we broke the downtrend again. We broke that downtrend again. You know, we're just going to keep doing this over and over and over again. Look how many downtrends we've got. Which one's right? Yeah, everyone's right in the retrospective. It's potentially a breakout trade, but does that mean we're going to return to all-time high? Does that mean we're going to crunch from a bear market to a bull market? Not really. You can base a small trade off it, but it's not an indication that the whole market's about to change from being extremely bearish to extremely bullish.
While you're on the daily there, can you just run like a bearish fib on pretty much each one of those tops?
Yeah, they pretty much did all the exact same things. So that first one there pulled back just above the 618. Sorry, I dropped that down a bit. Back above the 618 and then shat the bed. This one here, from here, double top on the 50, shat the bed. Do this one here, 618. 618, shat the bed.
It's like magic.
Pull back to this one, 618, shat the bed. Let's do this one. Might have to zoom in on this one.
Almost hit 618 on that one.
Yeah, almost hit the 618, shat the bed. Yeah, if you just use that one strategy, you would have done 3 or 4 very, very profitable trades throughout that few years. You know, these are 42% shorts if you had a shorted on each one of those. Now, if you can imagine, you know, I use 100x leverage. So each one of those would have been about, 4,200%, 4,000% trades on each one of those. So even if you just put $1,000 and compounded that 4 trades, you'd probably end up with a fair amount of money. Not that I did that. That would have been phenomenal.
We've got another question there too. Who was that? So trends leave a lot more variable. Yeah, absolutely. Like I said before, I think trends are, and in a way, when I'm just looking at a chart, just for me myself, I like Donny. I don't draw a heap of shit on it. I might mainly draw stuff just to show other people, but I can I've been staring at charts for that many years that I can sort of see what I'm looking at without having to draw the lines on it. But I think trend lines is more to help market structure, to help you see market structure more than anything else.
That's it.
Gospel.
I prefer to read market structure than trend lines, and trend lines will give you that, you know, specific price point, but market structure is telling you which way we're going. So if you're using trend lines to point the direction you're going, I mean, you can just visually look at that and see it's going up, right? You don't need to draw a line in there. Yeah. But what I'm looking at is higher highs and higher lows. That's the market structure that I'm looking at. So I'll use a trend line for that sort of thing, but I won't really use any serious trading strategies off it. Apart from squeezes, that's about it. But even then, I don't trade the breakdown on the trend line.
Andrew asked a question as well, and then I think we might have to wrap it up after this one, guys. But Andrew just said that how do you make money on the down when it bounces?
He's saying, how do I make money shorting, like when the price is going down? Is that what you're asking, Andrew?
Can you clarify that, Andrew? So you're saying that, you know, when the price is going down, has a bounce and then continues down? I'm not sure if he's still there.
Andrew, it says Andrew's still there. Oh, there he goes. Don't need to be rude, guys, but have to shoot. But you show me a lot more money. Oh, yeah, no worries, mate.
That's right. We'll come back to that another time anyway.
Yeah. Yeah, I'm not too sure what you meant there, Andrew. Whether if you're talking about how do you make money on the way down, well, you take a short position, so leverage trading. If you're talking about how do you make money on the down when it bounces,
So I think a lot of people, especially in the crypto den that are holders, they only know how to make money when the market's going up. They don't understand the concept of shorting. And I'm not saying everyone's that way, but
well, maybe that's something we should go over next week.
Yeah, I think we'll go with that another time.
Understand the concept of leverage trading and how that works.
Yeah, I think that's a good idea. But guys, like Donny said, he's going to make a form for you guys to fill out, and I'll post it in the Crypto Den. Any questions, just put that in that form so that we can sort of come up with a bit of an idea of how to best answer everything. And I'll post the link for the next Zoom on Monday for you guys to register as well. So if you've got any questions between now and then, feel free to shoot me a message on Facebook. I'm always about. I know, Simon and I've been talking a fair bit. Stephen, anyone that, I've been talking to you guys a lot lately. So if you've got any messages, just shoot me a message, and any questions, I should say, shoot me a message, and I'm happy to answer them for you. And we'll put together something for next week as well.
Too easy. All right, guys. We'll finish up there. Thanks for jumping in, and see you next week.
Sweet. Thanks everyone for coming. Thanks again, Donny. Appreciate it, mate.
No worries, bro. Talk to you, man.